Hello traders, Mandla here at FX Link. Thank you for joining us on our weekend market prep videos. In this video, we are going to take a look at a simple structure-based trading opportunity using only Fibonacci tools and price action to form our rules of engagement. Hey gang, today I want us to take a look at Australian dollar versus the US dollar pair. Now what's interesting for me is that on the daily time frame, ever since the buyers of this pair broke these levels of resistance right here, right? So ever since these resistance levels were broken, buyers began to slow down on its way up to resist over here, right? And if you have been tracking this market with us, you'd have noticed that we actually anticipated a reversal coming to these resistance levels right there. Okay, so as I pay a closer look on this one, you'd notice after these two bullish breakouts, 2 bullish days, we started making a consolidation on its way up to these resistance levels, and the price broke up, then gave us a break below, close below these lows right here. Okay, now that I know that what the market has done, I want to know where is the market more likely to go at, so that I can form my bias on that particular fact, right? And if price gives me a break below, close below, I know that price action is more than likely to go bearish than bullish. And if I know that price is more than likely to go bearish, I want to set myself up for a shorting position in anticipation of a next bearish move. Okay, now as you go to the lower time frame, you would notice that me kind of delete these, excuse me guys. Let's take a closer look on this one. Okay, the next bearish move where the market could actually find trouble at is somewhere right here between these resistance levels right here, right? Between these levels right there and these support levels coming over right here, right? Either price is more than likely to pause at these levels and then continue up, or price is going to break below these levels, right? But I don't care what price does over here. In order for me to catch this next move, I want to know how will the market go there. Either price could shoot straight down on this level to these levels of structure, or price could retrace back and then shoot to these levels of structure. So in order for me to catch a best risk to reward opportunity, I'll be looking for a particular retracement and advancement of bearish move. So these levels of structure would be quite interesting as I go to my lower time frame right here. They will give me a pretty good level where I'll be looking for a potential shorting opportunity, right? So as we get to the lower time frame on our 1 hour time frame, what I'll be paying a close attention to is my RSI. So if price does actually come closer to these levels of resistance, right? The best scenario is if price does come to these levels of resistance, I'll be paying a closer look on my RSI, hoping that price could give me an overbought state so I can set myself up for a shorting opportunity, right? And as you see, as I take my Fibonacci tool from this swing high, okay, to this swing low, you would notice that I get a 618 retracement at these resistance levels right here, and a 382 retracement at these support levels right there. So let me narrow this down. Now, as I take my Fibonacci extension tool, okay, from this swing low right here to this swing high right here, you would notice that our 1618 aligns with our 618 retracement, and our 50% retracement aligns with that 127 extension. Okay, so since I get a Fibonacci confluence right here, I will personally be looking for a selling opportunity over to here, over at this zone, and particularly this selling opportunity would set me up for a reduced risk to reward ratio, right? So price could easily come to this 382 retracement and then continue bearish and retest these lows right here. Okay, but for me to set myself up for a good risk to reward ratio, I will be looking for a selling opportunity over to these levels of structure. So as we take a look, compare the risk to reward on both scenarios, you would notice that if you want to short at that 382 retracement, your target would go to these current lows right here. Okay, and your stops would have to be 10 pips above those highs. So you would be risking 60 pips for 75 pips. It's a little bit more than a 1:1 risk to reward, for meaning that for every $1 that you are risking, you will get $1 back. But for me, that's not quite good scenario to put myself in, right? I want to win more when I win a trade, and lose less when I lose a particular trade. And in order for me to set myself up for those scenarios, I will be looking for a much more risk to reward, much better risk to reward, particularly a 1:2, right? So if I enter on that 50% retracement, that's if price does come over there, then I'll be setting myself up for a shorting opportunity in anticipation of a next bearish move to these levels of support. So I would have to have my stops, okay, currently at those levels. So I'll be risking 40 pips on this one for a 100 pip risk to reward. Okay, so you would notice that this risk to reward is much more better than this one. I'm not saying this one is a bad risk to reward. Most of the professional traders trade a 1:1 risk to reward, but I'll be setting myself up for a 40 pip risk and a 100 pip reward if price does come over to these levels of structure, with certain filters, of course, looking for a overbought state over there and a potential bearish divergence, so I can get in to these levels of structure. So I hope you enjoyed this video, and if you did, press that like button below, share this content with as many people as you can, as you know that I believe in community, and subscribe to our channel so you can get more of these free content lining up for you on a consistent basis. So for me, Mandla, I will see you on the next trade, and I'll keep you on the loop throughout the week. Goodbye.